Hello everyone. Many individuals are unsure of how to recognize the signals to sell at the peak of the market, fearing the uncertainty of when to exit after purchasing stocks. If you've ever found yourself unable to avoid significant market downturns, crashes, or bear markets, or if you've been trapped holding declining stocks without knowing how to disengage early, this video is specifically designed for you. In it, I will share my market analysis secrets without holding anything back. These 4 signals are the culmination of over 10 years of hands-on experience in the stock market, helping me to hold cash before several market downturns. Therefore, I strongly recommend watching this video until the end, as it could potentially save you a significant amount of money. It could also significantly elevate your level of expertise in stock investments. Understanding when to exit is more crucial than knowing when to buy. It's a key factor that determines how much you could win or lose. I shall also share my perspective on the current market in this video. This video will primarily use the S&P 500 index as an example to illustrate the 4 strong signals for recognizing market peaks and knowing when to exit. These signals are not only applicable to the US stock market, but can also be applied to other stock markets around the world. First signal. It's essential to learn to recognize a distribution day, which, as the name suggests, is a day of significant selling pressure. This may occur when institutional investors sell off, since the market direction, up or down, is shaped by the buying or selling actions of major investors. When analyzing market charts, it's crucial to interpret the signals of large holder activities. Identifying a distribution day involves 2 criteria. Take the 22nd of November as an example. The first criterion is that the trading volume on a down day exceeds that of the previous day. The second is that the day's volume surpasses the 50-day average trading volume. A blue line indicating the 50-day average volume on the chart highlights this. If both conditions are met, as they were on the 22nd of November, it indicates significant selling pressure beyond the capability of individual investors, marking it a distribution day. It's worth noting that a distribution day isn't exclusively a down day. It could also occur on a day with a slight increase, or if the market opened high but closed with minimal gains, as long as the volume is greater than the previous day and exceeds the 50-day average. For instance, the 5th of November 2023 saw a slight increase with a trading volume of 2.572 billion, above the 50-day average and the previous day's volume, marking it as a distribution day. The critical point follows. While 1 or 2 distribution days are common, but 4 within a span of 2 to 4 weeks signals a cautionary alert, prompting you to be on guard. To reiterate, first signal is the presence of 4 distribution days within 2 to 4 weeks. Should immediately put you on alert, and the distribution day is defined by either a decrease or a minor increase in value, but with trading volume exceeding that of the previous day and the 50-day average. Next, I will introduce the second and third signals, which, when applied together, can significantly enhance your market exit timing. The second signal involves paying attention to abrupt and unusual market movements. What do we mean by abrupt and unusual? It refers to sudden and strange fluctuations, like a significant drop in a single day. If you're familiar with candlestick charts, you might notice a large bearish candlestick here. Typically, these abrupt movements involve swings of around 3% or even higher, which are not expected in a normal upward trend. A significant downturn indicates a mass exodus of capital from the market on that day, signaling an unhealthy market condition. Furthermore, apart from a large bearish candlestick, an abrupt movement can also include a gap down. It indicates that many investors were so eager to sell that they did not wait for the market to open, resulting in a gap down. Moreover, the trend for the entire day continued downward, meaning that from the moment the market opened, many investors were eager to leave the market, valuing cash over holding stocks, with no large investors willing to buy in a panic and push the market up. Instead, you see investors of all sizes continuously selling off throughout the day, resulting in a bearish candlestick at close, indicating no buying power in the market. With selling pressure dominating, the third signal is to observe the percentage of stocks above their 50-day and 200-day moving averages within an index, and look for divergent signals compared to the overall market trend. These indices measure the percentage of stocks that are currently above their 50-day or 200-day moving averages. For instance, if the reading is 61, it means 61% of the stocks within the index are above their 50-day moving average. Similarly, this reading indicates that 68% of the index's stocks are above 200-day moving average. These metrics can provide a clear divergence signal when they move in opposition to the general market trend, offering a strategic insight into potential market shifts. Regarding how these indicators are set up, as well as all the chart settings I commonly use, if there's a demand for a deeper, hands-on explanation, please leave a comment. If there's enough interest, I'll create a detailed video to share with everyone. I won't go into detail here. Now, back to the third signal. Why are these two indicators so useful? The reason is that they can tell us more deeply whether the current uptrend is solid, that is, while the index is rising, whether the constituent stocks of the index are also in a healthy uptrend or during a downtrend, whether the constituent stocks are still weak or have begun to strengthen. This helps us to know the true state of the index at that moment, since an index is composed of its constituent stocks. When assessing the market condition, we should actually base our judgment on the real performance of these stocks to determine the overall market health. Thus, the market index is really just a lagging indicator. If your analysis of the market doesn't start with the essence of the market, which is the performance of the individual constituent stocks, you'll always be chasing shadows, always a few beats behind the market, because you're using secondary, non-critical information to interpret the market. This secondary, non-critical information includes news from the internet, newspapers, major media outlets, current events, market information, analysis, opinions, and so on, as well as many commonly used technical indicators like RSI, OBV, etc. I've spent many years studying these technical indicators, only to conclude that they were a waste of my time and money. Thus, I do not use these traditional technical indicators like Bollinger Bands, RSI, etc. Instead, I focus on studying actual price action, volume, and trend performance, as these represent primary information, not secondary. Now, let's apply these two indicators using a recent example. From mid-April 2021 to January 2022, the market continued to rise. However, if you only look at the surface, you might still be buying or holding to larger position at these levels. Just like a person who is just getting sick might not show any symptoms on the surface unless you take their pulse or conduct a physical examination. You won't know that their body is already showing abnormalities. So, when you want to understand the true health of the market, you need to look at these signals we've just mentioned. Let's give the market a physical examination. Here, I draw a trend line showing the market is still rising, but let's look at the percentage of constituent stocks above their 50-day moving average. While the market was continuously rising, this percentage was actually falling. What does it reveal? It tells you that as the market was rising, more and more stocks were falling below their 50-day moving average, indicating that fewer and fewer stocks were participating in the uptrend. Now looking at the percentage of stocks above their 200-day moving average, you will see a similar pattern, in which this percentage was also falling. Remember, the market was still rising and even reaching new highs at the time. Why then did the percentage of stocks above their 50-day moving average decrease? And why did the number of stocks above their 200-day moving average also decrease? The reason is smart money was leaving the market. The uptrend you saw was not healthy. It could just be a smokescreen played by the big players, using a small amount of capital to prop up or continue pushing up some of the heavier weighted stocks, while a larger amount of capital was being cashed out from other stocks. This creates the illusion that the market is still in a state of peace and prosperity. And the unfortunate individual investors, if they can't see the essence of the market, are easily misled by the apparent market rise. They might see some stocks falling and think it's an opportunity to buy cheap because they perceive the market as still safe, thinking they've found something valuable, not realizing that the so-called cheap stocks falling are exactly where the big players are quietly offloading. Now, integrating these three signals, let's examine the major market downturn of early 2022 as a case study. On the 22nd of November 2021, the market experienced a slight decrease, opening high and attempting to continue its ascent, but eventually declined. However, the trading volume that day was higher than the day before, at 2.4 billion, compared to the 50-day average trading volume of 2.05 billion, indicating it was the first distribution day. The second distribution day was on the 30th of November, a day that saw a decline, with trading volume significantly exceeding both the previous days and the 50-day average, fitting the criteria for an abrupt market movement. Following this, the 14th of December also experienced a decline, with a drop and trading volumes surpassing both the previous days and the 50-day average. It's important to note that the unusually high trading volumes on the third Friday of March, June, September, and December should be disregarded for analysis, because these days are future settlement dates, which naturally see increased trading volumes. Then came to the 4th of January 2021, the fourth distribution day, also a day that saw a decline, with trading volume significantly exceeding both the previous days and the 50-day average. Based on these initial signals, by the 4th of January, it became clear that one should significantly reduce stock investments and hold cash to minimize risk. Furthermore, let's check the ratios of stocks above their 50-day and 200-day moving averages. For any divergent signals, as had been shown, the proportion of stocks above their 50-day moving average was decreasing while the market was still rising, displaying a divergence, as was the percentage of stocks above their 200-day moving average. These were strong signals, indicating it was time to exit the market, potentially avoiding the subsequent 25% crash and bear market. Let's look at more examples, including midterm adjustments, such as the one in February to April 2023. During such midterm adjustment periods, many individual investors often lose a significant amount of money. A market downturn of 8 to 10% can result in individual stocks dropping by as much as 30%. These midterm adjustments frequently cause losses among individual investors, not to mention during major bear markets, where some may lose the majority of their wealth. If you find this video helpful or believe it could assist others, please like and share it. Your engagement can increase its visibility, potentially helping more people, your friends and family, to avoid major market downturns and protect their hard-earned wealth. Considering this midterm adjustment, the first sign of a distribution day was on the 17th of January, with a slight decrease but a larger trading volume than the previous day. The following day, the 18th of January, was a downturn with an even larger trading volume, exceeding both the previous days and the 50-day average. Then, on the 25th of January and the 3rd of February, the trading volume on the decline was higher than the 50-day average. On the 3rd of February, the market exhibited high volatility, closing at nearly the lowest point of the day, indicating an abrupt movement, the appearance of 4 distribution days, or suspected distribution days within a short span 2 to 4 weeks should raise an alarm. If you hadn't exited by the 3rd of February, you would witness the 5th and 6th distribution day on the 8th and the 9th of February, with a larger volume than the previous 2 days and above the 50-day average. The percentage of stocks above their 50-day moving average showed divergence, although the 200-day moving average hadn't yet signaled divergence. However, with 6 distribution days, some abrupt movements, and divergence in the 50-day moving average ratio, it was clear the market was off, signaling caution. If you're risk-averse, selling your stocks and exiting the market by May 3rd February would have allowed you to avoid a subsequent 9% market adjustment. This scenario is about 90% in line with the 3 criteria I've outlined earlier, compared to the January 2022 example, which matches 100%. This indicates a mid-term adjustment. But when you encounter a case that fully meets the criteria, it signals a high likelihood of a stock market crash. Next, I'll introduce the 4th signal, identifying a climax run, which is also a signal of a market peak. While it might not precede every stock market crash, bear market, or significant downturn, the presence of a climax run warrants heightened vigilance and preparation to sell your holdings. What characterizes a climax run? By definition, it involves a sharp, steep increase in price. It's crucial to discern climax runs that signify a potential peak, to avoid prematurely selling and missing out on substantial gains. A climax run typically follows an extended period of orderly gains. For example, during the bull market of 2017 to 2018, which began in November 2016, the market rose steadily. How do we know it was an orderly rise? By drawing trend lines. These trend lines show that the rise from early 2017 to November 2017 was at a consistent angle, indicating a healthy ascent. Let's zoom in a bit to make it easier to see. Towards the end of 2017, specifically after November, the index began to deviate from its normal trajectory, adding another trend line for November to December 2017. We can see a change in the slope, indicating an extended rally, but not yet a peak signal. From early January to the end of January 2018, the market's trajectory took on an even steeper angle, different from the previous period's slope, marking the climax run. This steepness signifies that the amplitude of the market's fluctuations was significantly large, within a very short time frame. Additionally, during this climax run, the daily gains were typically larger than those seen during the preceding extended rally and the earlier phase of the bull market. This compression of time indicates that the end of the rally could be near, as a climax run following an extended rally suggests an exceedingly bullish market atmosphere, with both individual and institutional investors aggressively buying stocks when market optimism is at its peak. A surge in individual investors buying into funds can lead to increased stock purchases by these funds, often marking the market's peak. When daily gains become exceptionally large in a very short period, during this phase, the first distribution day appeared on January 16th, followed by a second on January 24th, and a gap down opening, with increased trading volume on January 30th, marking the third distribution day. These indicators suggest the need for caution, as the intense buying activity and steep price increases, typical of a climax run, can often precede a market top on January 31st, with minimal price change, but a continued increase in trading volume, marking it as the fourth distribution day, and coupled with a gap down on January 30th. A sudden and abrupt movement. It was a clear signal that exiting on January 31st would have been prudent. If you didn't sell all your stocks on that day, then by February 2nd, you definitely should have, as that day presented a large bearish candle and a gap down. closing near the day's low, indicating a significant drop. The candlestick body for the 2nd of February was much larger than any previous day's decline, signaling the end of the rapid price increase and a strong indication of a market peak, thereby offering the final chance to exit. Suppose you exited at this point. You essentially left the market at its peak, avoiding the subsequent 8% downturn and the ensuing high volatility over the next 2 months. In summary, today's key lessons on the 4 major signals for market peaks and exit cues are: 1. 4 or more distribution days within 2 to 4 weeks. 2. Abrupt and unusual market movements, such as gap-down drops with significant declines and unusually high trading volumes. A peak signals. 3. Decreasing percentages of stocks above their 50-day and 200-day moving averages while the market continues to rise, indicating divergence from the overall market trend. 4. A rapid price increase following an extended rally, culminating in a day of significant decline, marking the largest single-day drop in months or even a year, serving as a strong exit signal. Finally, let's consider the current market situation. 3 signals have occurred, and I've significantly reduced my positions to avoid a potential substantial midterm adjustment. The market might continue to rise in the coming weeks, but being relatively risk-averse, I'm cautious. A single downturn could cost me a significant amount of money and force me out of the game. That's all for today. If you find this video helpful, remember to share, comment, and like, subscribe to the channel, and hit the notification bell to not miss any future videos. See you in the next one.